Following what was a pretty dismal year in terms of performance for the S&P TSX REIT sector, the index appears to have bounced back. Of course, not all real estate investment trusts are built the same, and some are poised to outperform more than others. To discuss where the opportunities lie, I'm joined by Dennis Mitchell. Dennis is CEO and Chief Investment Officer of Starlight Capital. Dennis, great to have you back.
Thanks for having me, Saijal.
So 2022 wasn't exactly a great year for the REIT index. I was reading that it was down 15%, I think the third worst in terms of performance. We're still dealing with a lot of economic uncertainty. So are you expecting a better year overall for REITs?
Yeah, I would say we are expecting a better year. And if I look at what happened in 2022, actually the S&P 500 is a great way to sort of take a look at what happened in equities in general last year. And so what you saw last year was earnings were actually positive. You know, the S&P was off, I think, 15 or 16%, but earnings were actually positive 3%. What you saw was a collapse in multiples that stocks traded at. And so that was a negative 19% impact. And that's what got you to your negative 15%. So if you move that to real estate, what you saw was that the earnings of North American real estate companies and REITs actually grew by about 10, 11% last year. It was the multiples collapsing in the face of a sudden and dramatic increase in interest rates that drove returns. So if you look at US REITs, their multiples collapsed by 44%, by far the highest decline in market trading multiples versus earnings growing by 11%. And it's a similar story in Canada, where the multiples that Canadian REITs traded at collapsed, but they actually generated positive earnings. In fact, the only sector last year that generated better earnings growth than real estate was energy, for obvious reasons. Huge rebound in sort of earnings growth and mean reversion. But even there, they saw multiples contract in the face of higher interest rates.
Oh, so this is really interesting. So earnings grew, but multiples collapsed. Can we talk a little bit more then about the interest rates? Because obviously at elevated levels, the REIT industry and the operators have had to adjust. What are you observing? I mean, what are they doing to cushion the impact?
So great question, Saijal. And by my goatee, you can see I'm old enough to remember when interest rates were at these levels 20 years ago, and then the ride down to zero effectively. So I remember in 2005, 2006, rates beginning their precipitous decline down to record lows of 0%. And for years and years, market prognosticators said that interest rates were going to have to go back up. Inflation was going to become untethered, and we just didn't see that. But in response to that narrative, real estate companies started to extend the term of their debt. So people who normally borrowed at 3 years started borrowing at 5 years. People who borrowed at 5 went to 8, and you get the idea. And what happened over the last 20 years is that debt that was termed out to take advantage of the temporary low interest rates all matured, and interest rates were even lower. So they termed out even longer. So what you see is that across real estate, whether it's publicly traded REITs or, in fact, mortgages for homeowners, everyone is locked into very low interest rates for very long periods of time. Over 80% of the mortgages on residential homes in the United States are below 3%. And Americans tend to borrow 30-year money when it comes to mortgages. So, there's really no impact in the short term of rates going up on homeowners in the US. And if you extend that to Canada, the lion's share of existing mortgages are well below sort of 3% and are fixed rate for a 5-year term. And then if we look at the publicly traded real estate companies, the lion's share of their debt has been termed out for very long periods of time at very attractive interest rates. So the sudden and sharp increase in interest rates, first, it impacts the multiple. So that's what I was talking about in terms of multiples collapsing. Now going forward, we'll start to see its impact on actual earnings. When people do have to start refinancing debt, they'll have to pay more for it. But what we're actually seeing companies do is, for those who have, unfortunately have, lower rate debt that is maturing this year, they're choosing to simply retire the debt, or they're choosing to pay that debt down, or they're extending it for a shorter term to get a lower interest rate. But they're not simply just saying, here's $100 million of debt that we were paying 2% on, and now we're absorbing 5.5% or 6%. No one's interested in doing that. So there is a lot of sort of strategic repositioning that's taking place, and you are seeing companies even going as far as recycling assets, right? Selling
Yeah,
non-core assets to retire the debt that's attached to them, or to retire higher interest rate debt that they have in their capital structure.
right.
So
Yeah.
nobody is simply saying interest rates are going to undercut our business and destroy our cash flows. Everyone's been working studiously over the last several years to lessen the impact of higher interest rates.
Welcome back. Dennis, obviously lots of different types of REITs. The last time that we spoke, you liked industrial REITs. Do you still like them?
We certainly do. Between industrial and residential, that's more than 50% of our portfolio. What we like about industrial is, first, it's a global market. Two, there is significant demand. There is not enough supply to meet that demand. In North America alone, it's interesting again, the narrative is that we have record levels of supply at about 400 million square feet. What gets overlooked is that there are record levels of demand at over 500 million square feet. So you have a market that is right now 3% vacancy and falling. You have significant incremental demand that won't be satisfied by the incremental supply. And to your point about rising interest rates, inflation driving up, construction inputs and labor costs going up, the cost of making new supply has gone up significantly. So we like industrial. We are seeing rent growth in some of our large cap names of 60%
Wow.
on lease renewal. So it's an area where we're getting great yields and where there's an outlook for even greater cash flow growth and further distribution growth.
Okay. What about, you said you liked residential REITs as well. That's a big part of your portfolio. Is this, Dennis, because of, tight supply? Because with rising rates, construction, like I'm hearing a lot that, construction's kind of stalled, which means that if supply is tight, it keeps rental costs high and leases high. Is that part of the reason?
Yeah, you're absolutely right. What we have in Canada in particular, but every developed nation around the world, is you have a situation where people want to come here. And so Canada is a poster child for that. We were accepting 250,000 immigrants like my parents every year, and we've now pushed that number to 500,000. That's into a market that is right now 2% vacant. But if you look at the big six markets across Canada, Vancouver, Edmonton, Toronto, Calgary, Ottawa, Montreal, those markets are now bordering on sub 1% vacancy. So you have a market that is already extremely tight, and you're adding incremental demand to it. And the final piece of the equation, supply, is in short supply, ironically. A lot of the government's sort of measures at the federal level are focused on increasing the population and creating and pulling more demand from the future. Creating products like the tax-free savings account, the first-time homebuyer savings account, the withdrawal mechanism out of your RSP for your down payment on your first-time home purchase. All of these are designed to expedite the amount of people who can buy a home today. It's pulling future demand forward. Unless you can meet that with incremental supply, it's going to keep occupancies very high, vacancies low. It's going to keep rents elevated, and it's going to continue to create demand for single-family homes that pushes home prices up. So these are all positive if you're a residential landlord, but it makes it very difficult if you're someone new to the country or someone who's trying to start a family, or you just need to keep a roof over your head.
Yeah, for sure. Office REITs. Walk us through, Dennis, what's going on here, right? Because I guess especially in light of the hybrid work model, but you're also hearing, a lot of employees are being asked to go back to the office. How is all of this affecting the office REIT space?
Yeah, so many factors at play here. So during the pandemic, everybody went home and you had very little physical occupancy, regardless of what your economic occupancy is, right? And economic occupancy is, I have leases signed with company XYZ and they're paying for this space. Physical occupancy is how many people are actually coming to the office to work. And so there's a huge divergence here. And yeah, you're right. A number of companies said everybody's got to come back to work. Elon Musk was famous for saying, if you're not willing to come into the office and commit to hardcore work, then we don't want you. And that kind of backfired. And now he's saying, like, if you want to work from home, that's great. The pendulum is going to swing back and forth for quite some time. If you want to work virtually from home, well, if I'm paying you to work virtually, then I don't need you in Toronto or Barrie or Niagara Falls. I can have you in Thailand, right?
Mm-hmm.
And so the pendulum is going to swing both ways. So what I think is that incrementally the demand for office is going to become less. And so if you are going to get involved in the office space, you're really going to have to limit it to very, very class A or class AAA premium assets in the downtown core in, gateway markets like Toronto, New York, San Francisco, Paris, London. You're not going to want to own suburban stuff in secondary or tertiary markets.
Yeah.
And quite honestly, I don't think people should be involved in the office market at this stage, period. We certainly are
Okay.
not.
Okay, Dennis, we really appreciate your time today. Thanks so much for
Feedback,
coming on.
Saijal.
Dennis
Thank you.
Mitchell of Starlight Capital. Well, that wraps up this show. To catch previous episodes, head over to thenewsforum.ca or you can follow the Newsforum on YouTube. Thanks for watching. Until next time, stay well, stay wise, and stay wealthy.